Okay, so now that we've taken care of our foundation and we recognize that we need to have some key components in our system, we're going to share what the Ascendant Traders components are to our trading plan. Now, we've already shared that we have broken our trading plan down into four areas. First and foremost, we need to identify the trend. What direction is the market moving at the current time? Then we want to find locations to enter the trades, support and resistance, moving averages, and pivots. As we approach those locations, we want to have some type of trigger to let us know that it's time to get in the trade and also get out of the trade, which has to do with management and trade management, managing the trade, and identifying our stops and targets in our risk to reward ratio. So we're talking about trade direction, and we have to know that the old adage is the trend is your friend. And as you see in our picture here, there are often trends inside of trends, long-term trends, short-term trends, and we have to be able to take advantage of that as traders. The primary goal of traders is to take advantage of the changes in price. So we want to identify trends so we can buy low and sell high. But which most people know, but most people, you might be surprised to know that a lot of people are not familiar with the short high and cover low. By identifying the trend and being able to draw trend lines and whatnot, so we can take advantage of that trend by taking advantage by using the proper strategy, buying low or selling high. So, what are some ways that we as senior traders identify trade direction? Well, the first thing we're going to do is identify that trend on multiple time frames. And the best case scenario is to get confirmation between all three of those time frames, the 5, the 15, and the 60-minute time charts. If they're in accordance and agreement, then we have a great entry into a trade. We also want to use technical indicators as a sort of confirmation of what the charts are telling us. And then we also want to see what the price is in relationship to key price levels, for example, the daily pivot and the opening range. So yes, we've said it over and over again, and you've heard it, the trend is your friend. So what we like to do is have a 5-minute, which is on our left, a 15-minute, which is in the middle, and a 20-minute chart. And in the simplest form, all you really need to have are two moving averages on those charts. Here, we have the yellow or goldish indicator, that is a 5 moving average on each of our time frames, and the blue is a 20 moving average. And we also have that on each of our time frames. And so when the 5 is below the 20 moving average, we have a market in a downtrend on the 5-minute chart, or in this case, the 5 is below the blue, so we're also in a downtrend on the 15-minute chart. And finally, here on the 60-minute chart, the 5 is below the 20 moving average. So on all three time frames, we have the 5 below the 20 moving average. So we're in a downtrend according to this time frame, and we want to be shorting retracements and looking for trades to the downside. Now, we have a couple indicators here. Many of you know that we are like many of the technical indicators developed by First Wave at WallStreetTeachers.com, Dave Elliott. And so here we have two of his indicators. We have DPO MOBO, which is the mobile bands on a DPO, and we have TEMA, which is triple exponential moving averages. And you can see here our moving averages are pretty much in agreement, except for here on the 5-minute we have DPO going up, but we also have down, 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 down. So when you have this amount of confirmation, again, we want to be looking for short-term trades to the downside. The daily pivot. The daily pivot is used by many floor traders and professional traders, and it's just important for you as a trader, especially as a day trader, future trader, to be aware where it is and understand what happens when price gets closer to that level. It's derived by calculating the numerical average of a particular stock's high, low, and closing prices. There you go. We have the pivot being P, R1, R2 is resistance 1, resistance 2, and we have S1, S2, support 1, support 2. So we're going to take the pivot, start with the pivot, and identify the high plus the low plus the close and divide it by 3. And then we use the pivot to identify support 1 and support 2. When we are below the pivot, it should act as resistance, all of them, the pivot, support 1 and support 2. And we also be thinking that, again, looking at trades to the downside because we are below the daily pivot. There are some trading systems that says simply because we're below the daily pivot, all of our trades should be short. Likewise, if we're above the daily pivot, then it should be acting as support, and we should be looking for trades to the upside. A very general rule. What's more important is that you understand what the pivots are and how to calculate them. Now, many of us don't want to take the time to actually go ahead and do the math. So there are a couple ways. You saw on the last chart, I had some pre-calculated ones. There's some popular ones out there called Woody's pivots, person pivots. I like to use those, but many of the professionals, I'll be honest, professional traders, floor traders use mypivots.com, where you can come in and enter the value into our little grid here, and then it will calculate, so you don't have to do that math for us. You enter the prices and it will calculate the pivots for you. Now, another key price level is the opening range. And the opening range is different for different people, but in its simplest form, the opening range is the high and low price of a given time frame. In my example here, the market opens up at 9:30, and I have a half hour, a 30-minute opening range. So this is the low of the first 30 minutes of trading. See, 10 o'clock. And this is the high of the first 30 minutes of trading. And what you want to do, similar to the daily pivot, if you're below the opening range, you want to be looking for trades to the short side. Inside the opening range can be considered chop, and then above the opening range to be looking for trades to the upside. That is called the Crable method. What you will see, though, is that some people use different time frames. I like the 30-minute. Other futures day traders like to use the 15-minute for an opening range. And some people like to even go further out and do a 60-minute opening range. So you're going to have to play around with it and find out which one works best for you. But in the end, it's just, again, a key price level for us to pay attention to as we are trading the market. So to review, the first step in any trading plan, the first step in to get into any trade, any setup to enter the market, is to identify the trend of the market. You want to analyze chart patterns for highs and lows. You want to draw trend lines, identify key price levels, and use technical indicators to help you identify which way the market is moving. So let's pull up a couple charts and put on some of the indicators and some of the setups that we just talked about. So here we are. We've got a 5-minute chart, we have a 15-minute chart, and we have a 1-hour chart. And we're going to go ahead and put on our moving averages. Again, we have the 5 and a 20 moving average for each of these charts. So I'm going to go into my studies and look for my moving average. There it is. Put 2 on here. And again, we set a 5 and a 20, so I'm going to put a 20 moving average. I'll keep that blue. I'll change this one to a 5 moving average, and then change this to a gold yellow color. And through the magic of technology, I'm going to pause the video so that you don't have to watch me do this video the charts. So there we have it. We've got the 5 and the 20 moving average on each of our time frames. And again, we can see the 5 is below the 20. 5 is below the 20. 5 is just below the 20. Now, one thing to notice is that obviously they're also, by that rule alone, we're in a downtrend. Look for trades to the downside. The other thing to notice is the severity of the downtrend. I mean, when you look at the 60-minute chart, it doesn't look so bad, does it? And then the 15-minute chart doesn't look as bad as the 5-minute chart. So the reason why that's important is that you can come back to this chart and kind of eye some key price levels. in addition to the daily pivot and the opening range, I can look at this and see, well, there's a lot of wickedness going on here at 9:20 over here. Uh, and then I can pull down the small time frame and see something's going on at the 9:10, 9:13 type level. And then we can come over here and see that, first of all, you can see it was a long time ago. The other thing we can see is we want to sort of gauge the strength of the downtrend or uptrend. Now, I was watching a presentation by powercharts.com, by Rob Hoffman, and he calls it basically junior and senior trends. And what he's looking for is if you can get three to five bars down in a row, then that is a junior trend. Anything below anything below 3 is considered chop. So if you can get 3 to 5 bars down or up, that's a junior trend. Anything above 5 bars is considered a senior trend. And the purpose of that is to say that that is a very significant trend, and again, buy or short the pullbacks. So again, 1 to 3 bars in a direction equals chop, 3 to 5 equals a junior trend, and 5 or more is a senior trend. Again, that's from Rob Hoffman of PowerCharts or PowerCharting.com. Now, the next thing we need to do is to go ahead and add some indicators to this, just to give you some type of confirmation to what we see here in our moving average crossover. So as in our PowerPoint presentation, I'm going to add 2 indicators to this. Basically, again, you want to go ahead and find some technical indicators for confirmation. Many people might use MACD as a trend following. Some people use ADX as a trend following trend identification indicator. But again, I have access to some of the great scripts written by Dave Elliott, First Wave of WallStreetTeachers.com. So I'm going to use those. Now, if you're on the Thinkorswim platform, as I'm demoing here, you can find the DPO Mobile for free. So I'm going to put that on here. And then if you have access to his Google group, you can get some of his other indicators. And I'm going to add TEMA. Again, that is a triple exponential moving average. DPO is a indicator, and then he's just putting his mobile bands on that. And I'm going to pause the video as I add this on to each of the charts. And there we have it, and we can clearly see as our moving average, we're showing us that we're in a down. Now notice one thing, that our moving average is on the 5-minute chart, the 5 is below the 20, but it's angling up, and notice that our indicators here, DPO Mobile showed us to go long per the 5-minute chart about a half hour ago, and now the TEMA is confirming that. So on the 5-minute chart, we're starting to see the opportunity for a long trade. And notice that the 5 is about to go above. And we'll talk about later about rules what to do when times conflict. But we can see in our longer time frame, the 15-minute down on the moving averages, down, down. And on a 60-minute chart, down on moving averages, up on DPO Mobo. And you can see that because you can see this consolidation that we're in. And down on TEMA. So overall, we have a slightly negative bias, looking for trades that short to the downside. But this over here is showing me that if I wanted to take a counter trend trade, there is a possibility there. But of course, counter trend, you use to use position management rules properly, so that you don't affect your account. Now, what I want to do also is, if you do not have access to these indicators on Thinkorswim or to his Google group, I'll talk about some other indicators that you can use. As I mentioned before, you're basically just looking for some indicators that can measure trend. And like I said, some people do like to use MACD, so I'm going to put a MACD on here. and some people like to use ADX. I'll put that on here and pause the video as I add that to each one. So I've added MACD and ADX to each of these, and they're going to give you some of the same stories. We can see on the 5-minute chart, MACD, the DMI negative is about to go below positive, and the strong trend, this is the ADX, anything above 30 is considered to be a strong trend. We got up here above 40, but as the 5-minute is starting to go up, the ADX is going down, and we're getting ready to see a crossover. We can see on the 50-minute chart, we are still strong. We have a 45 ADX. Negative is above positive. But you're getting a little rounding off here as we get a little retracement. But it's still showing a strong downtrend on the 50-minute chart. And on the 60-minute chart, notice that we don't really have anything going on here. Because although we have DMI negative above DMI positive, our ADX is still sitting here at around 19, showing us that we don't really have a strong trend. MACD is crossed over, kind of correlates with the little up move here. Notice, look at the market trying to bounce here at the 20 moving average. That's why the 20 moving average is a good, and that's another good point, is that not only do we want to look at the crossovers, but we want to see the reaction of the market to indicate the investment tool using YM, whatever stock you're using, Forex, whatever. You want to see how they interact with the 20 moving average and the 50 moving average for that matter. So MACD's crossed over and heading back down. Over here, MACD turned positive for a quick second, even though we have the 5 below, and we have, you can see MACD showing us a little crossover here. And over here, MACD is turning negative. So again, this is also a way to measure trend. And there's other indicators that you can use that can measure trend. But overall, we first and primary want to use the 5 and the 20 moving average crossovers. Above the 5 above the 20 is bullish, uptrend. 5 below the 20 is bearish, downtrend. And you want to look for trades in those general directions because the trend is your friend. So once we identify that we're in an uptrend and a downtrend using our multiple time frame charts, the next thing we want to do is look at the price in relation to some key price levels. In our PowerPoint presentation, we talked about the pivots and the opening range. So here we have the pivots plotted for us. And again, you can use some of the most platforms, charting platforms should have the ability to some type of pivots already in there, like Woody's pivots, Person's pivots, or you can go to the website mypivots.com and calculate them and input these price levels yourself. But the main thing to notice is that we check the 3 time frames. We see we're in a uptrend or a downtrend, whatever it may be. And then we want to see where is price in relationship to the daily pivot. The purple line here is a daily pivot. So if we're above the daily pivot, we want to be taking, and we have confirmation that we're in an uptrend on our time frames, and we're looking for long trades. If we're below the daily pivot and we have confirmation for our multiple time frames that we're in a downtrend, we want to be shorting. The other thing to note is, again, watch how the market interacts, how it acts as it interacts with these key price levels. Here's a daily pivot, and notice that the market kind of bounced here. It was support. And then once it got below the daily pivot, it became resistance. And as we came down to support 1, and it became support. We broke it for a little bit, but it became support, and we moved up. Notice that pre-market, this was our Friday jobs report, non-farm payroll report, and we ran right up to resistance once and kind of failed right there. So again, notice how the market acts as it comes into these key price levels. There are people, professional traders out there who their systems are to buy the pivots or to sell the pivots, and the market will respond based on that action. Notice that this little high action here was a part of the next day's resistance. You know, these things aren't just accidents. They do happen for a reason. So the pivots, daily pivots, however you want to calculate them, are certainly a key price level and also can affect the direction that you want to be looking at. Again, if we're below the daily pivot, that affects you. You should have a slight bias to the downside. And above the daily pivot, you just have a slight bias to the upside. With regards to the opening range, I have a script here that goes ahead and automatically plots the opening range as they occur, and you can go in and adjust the time frame to. Right now, again, I have it set at 30 minutes. Some prefer 15 minutes at the 9:45 level, and others prefer 60 minutes at the 10:30 level. The main thing here again that we're watching with the opening range is just to watch how price interacts with that level. On many days, although this day I have in front of us is not the best example, but on many days you'll see that once those ranges are set, and if I were to go here and put in a 945, you can kind of see that the market did come back and test it right in this area here. I'll go ahead and do that. Price level, and I'm going to go right here. Change it back to a pointer so that I don't accidentally do that again. And you can see that, you know, price came here, bounced, the next bar held right here at the 15-minute level. We did break, come back. We tested it here, came up, came back, tested it here. All these wicks here are with that 15-minute level, and then down here at the 30-minute level, we're getting some interaction. And even when we came back, we paused here at the 30-minute level, and then we saw some wicks and some action here at the 15-minute level. So it's just, again, interesting to notice what the market does at this opening range. And the general rule is when you're below it, you should have a short day, shorting retracements, and when you're above the opening range, we had this wick up here, you should be looking for long trades and buying the pullbacks.